Hey guys, we got a treat for you today. We're interviewing Scott Trench from BiggerPockets.
Brian, I am so excited about this because we're going to be talking about something that is on everyone's mind. And we have a resident expert here with us. For those of you who don't know, Scott is the CEO of BiggerPockets. It's home of the #1 real estate podcast with a 2.5 million member community in real estate investing. He's also written a book, Set for Life. He's the host of the BiggerPockets Money Podcast, and he himself is also an experienced real estate investor and broker. So, Scott, thank you so much for joining us today.
Thanks for having me, guys. Great to be here.
I wanted to kind of go ahead and set the table here, Scott, and the fact that we have talked a lot about real estate, the rising interest rates, the affordability of housing. I mean, think about this. The average mortgage just in the last few years, since 2020, has skyrocketed to where instead of being $1,314, so $1,314 a month back in 2020, now it's $2,953. This is the perfect time to kind of bring somebody who might have, I don't know if it's a different perspective, but it definitely give us the inside deets on what's going on in the world of real estate.
Yeah, well, I think that's the big story, right? Why haven't real estate prices come down more than they have already, right? And I think you guys had a really good breakdown of this on a recent show that I listened to. I forget the exact number of the episode, but you did a great job breaking down the market, and I would generally agree with all of your conclusions. The biggest thing in the single-family residential space is that what we call the lock-in effect, right? If someone has bought a home in the last few years with a 3%, or 3.5-4% interest mortgage rate, they're not going to sell their property, right, and move down the block. They're not going to upsize their house. They're not going to downsize their house because they've got this great rate. They're trapped essentially into this mortgage. And what that means is there's not a lot of existing home inventory coming for sale on the market. And that is propping up prices right now. It remains to be seen how long that can last, but I think we have a good bit of time. I wouldn't be surprised if there's not a lot of appreciation over the next several years, or even a slight downward trend. But I don't understand why a homeowner would voluntarily sell their home. You will see a floor to transactions because people have to move because family obligations, that new job that does pay so much more and is such a much better opportunity that you have to take it or you get laid off and move. So there's a floor to transaction volume, and that's what we're seeing now. I think it's a very gradual and years-long process, maybe 5-10 years before you see transaction volume approaching what we saw recently. And the one area I would kind of dive into where I would exclude from that analysis is new home inventory. We have a lot of new homes that have been permitted in the last few years, and builders will monetize their inventory. They will sell that. So I think that right now, and you can see this live in the market, is actually one of the best times ever to buy a new house, right? In terms of the leverage that you're going to get over builders and concessions and those types of things, relative to existing homes, and that will change over the next 2 or 3 years because nobody's starting new projects now. They're just finishing the projects that were already underway. So hopefully that's a helpful color on the backdrop of the market right now.
Quick question, interest rates. I mean, you talked about locked in. I mean, I'll confess that I have a 2.5% mortgage that I planned on paying off in the next year, but now it's just I have such a crazy spread between I make on my cash and that I've had second guessing that whole decision making process. But the question I have is, what about this 6.5% mortgage? I mean, does that, even if it's new home inventory, when you say this is still a great opportunity, what do you tell somebody who's facing, because it's not so far in the past that they don't remember what 2.5%, 3%, 4% mortgage rates look like, and here they are looking at 6.5%.
Great question. So I think we have to zoom back out there to answer that and thinking about the buy versus rent decision, right? And where does that decision get made? 2 years ago or a year ago, I would have told you that the break-even point on average in this country, according to a little Excel model I made, assuming 3.5% appreciation. So whatever you want to assume, but I would have said it was 5 to 7 years, right? Depends on which market you're in, but if you're in San Francisco, it probably is a little longer than that. If you're in Memphis, Tennessee, it's probably a little shorter than that, right? But it just depends on your market. What has happened, I think, is that the break-even point has really been pushed out, right? So is buying or renting a better decision? Well, with higher interest rates, you need to be committed to living in that property, or at least owning the property. You don't have to live in it for a lot longer of a time period to make up for the transaction costs, the higher payment, those types of things. It'll take longer for the long-term averages of the market to cover the spread in terms of cost between buying and renting an equivalent place.
Now, I know you don't have a crystal ball, but it's interesting. I'm hearing you talk about how there's people locked in and there's a lack of inventory, but then there's also this new home where there's going to be some opportunities there. So if I'm someone and I'm on the first time home buying thing, I mean, I think for most folks, before we even talk about like rental real estate and that sort of thing, for most folks, their number one largest investment is their primary residence, right? It's the home that they buy, that they live in. If I am somebody who's thinking about buying my first house, is now the time that I ought to be thinking about doing it? I just need to focus on new homes. Or are you saying there might be some softness and you got to figure out maybe renting is a better solution with interest rates right now? Is there some guidance that you give one way or the other?
Great. First, I'm gonna complain about the question, then I'll answer it.
Okay, awesome.
So is housing an investment?
Well, see, I would argue no. I say it's a use asset, but I think a lot of people don't realize when you buy your primary residence, you naturally have a bunch of real estate exposure, even though you don't comprehend that's part of my overall capital allocation. I'd be curious, do you disagree?
I think housing is an expense, right? My car is an expense. Right, my house takes money out of my pocket, right? And look, on an accountant will argue with me, right? But at a baseline level, and look, what I'm trying to do is achieve financial freedom. I want my assets to pay for my lifestyle, right? So in that regard, housing is a liability that I've got to cover, right? This is classic rich dad mindset, right?
Yep.
Rich dad, poor dad mindset. And I certainly subscribe to that school of thought. And so I think that the more you buy, the less wealth you're going to have over the next couple of years, whether you rent or buy your house. So in the context of that decision, what's the more affordable way to live the lifestyle you want to live? Is it buying or renting? And again, that comes back down to how long you plan to live in that particular property, right? When you buy a house, and regardless of the interest rate environment, you're assuming almost certainly that long-term it's going to appreciate in value. You're assuming that you're going to amortize your debt over time. You're assuming that the fixed cost of your mortgage, most people use a 30-year fixed rate mortgage to buy property, is going to not increase with inflation, even though your taxes and insurance will, and maybe your maintenance costs. Whereas with rent, you're assuming that that's going to go up over time with inflation. And so again, that comes back down to there's a break-even point there where buying a house is less costly, less expensive, right? Not a better investment in my opinion, but less expensive than renting. And for me, that averages to 5 to 7 years. And I think the math has changed for that. And it's a much longer time horizon for that, maybe 10 to 12 years with the much higher interest rate environment, because rents haven't gone up as much as the mortgage costs, to your point earlier.
What's interesting, I feel like I have to defend all of the CPAs out there, is that you actually are not, I love, because we said it in different ways, but it's the exact same thing, is that we say use asset, meaning this is where your shelter, this is where your family lays at night. So we don't like people to overinflate what their house is in their total net worth. So I always bring up the CPA term of the lower of cost or market. Now, cost can be, what you bought it at, plus any improvements that you put at. But that's what I like people to use for their valuation, so they don't get this false Shangri-La feeling that if you especially live in one of the coast, where if your house appreciated, high 6 figures or even 7 figures, you don't think, oh my gosh, I'm on easy street, because you still are living in this. Now, eventually, if you sold it, yes, you might have a windfall that comes your way, especially if you all of a sudden sell your 7-figure house and then move to some place that lets you buy a cheaper house. That's getting harder and harder to find. But I loved your answer, Scott, because it actually brought it in, because I hear so many people in the real estate marketplace talk about only how much you can appreciate, then lever, and then appreciate and buy. But you actually focused on, no, you've got to think about in terms of cash flow. This is expense coming out versus money coming in. How do you get enough assets that you can live off of that? I do want to, before we kind of get into, because I want to make sure we wrap up with personal residence before we move into real estate investing, because I want to give Scott his time to talk about that. But we talked about first homes. I want to know Scott's take on What do you do about a second house? Because we're very clear on the Money Guy Show is we love home ownership once you can get in if it makes sense, especially when you're doing that analysis of rent versus buy. But we give grace on the first purchase of a down payment of 3 to 5%. But on second homes, what are your thoughts on, looking at this market now, but also how do you pay for that if you're thinking about upgrading your housing?
So are you asking about buying a second home, like a vacation home?
Trading up.
Trading up. I probably should have used the word trading up. You're actually trying, because look, when you bought your first house, it's just you and your spouse. Maybe you had one child, but now you've got you're like Bo. Y'all decide you go expand where you're playing zone defense instead of man on man, and so you got 3 kids, 4 kids. What do you do? Should you trade up in this market?
I think you're locked in. I think you have no choice. I mean, you can if you have to trade up because that's what you feel your lifestyle requires. Your lifestyle requirements need that. Then you have really two options, right? Assume a much larger and much more a larger and more expensive from an interest rate perspective mortgage, or you can try to get creative. Right. And so there are a couple ways to get creative about this, right? One is you assume a mortgage. So some loans out there like FHA loans and VA loans are assumable as long as you live in the property. If you have the cash to cover the spread between the purchase price and the remaining balance on that person's mortgage, and you have a seller who's willing to do that and go through the extra complexities, you may be able to assume a reasonable interest rate mortgage in that purchase. That's true for both the bigger house and one that you'd be buying new, right? And actually maybe more prevalent among smaller or starter home properties. That's what I would be doing if I was trying to get into my first property today, is be looking for an opportunity like that and making sure I build enough of a cash position to have that optionality. And the second is, how can I use my housing to build wealth in a way that's beyond what a normal homeowner would do? So we have a term called house hacking at BiggerPockets that we like a lot, right? Where you buy a property and you move into one of the bedrooms or the basement, or if it's a duplex, one of the units, just like living in a townhome, for example. There's a spectrum here. I did this with a dumpy little duplex that was at a flat roof and no air conditioning when I got started in 2014, but you could do it with a nice townhome as part of a quadplex if you have the means, for example. And that will subsidize much of your housing and could be turned into a rental property when you leave. And then one other strategy is what we call the live-in flip. If you buy a house that needs a lot of work and act like a flipper, like repair it, hire contractors, but make a project that would be a profitable fix and flip project. When you go to sell that property, perhaps 2 or 3 years down the road, as long as you've lived in the property for 2 out of the last 5 years, you can pocket the entire capital gain tax-free, up to certain limits, 250 for if you're single, or 500 if you're 500,000 if you're married. So those would be tactics that I would really heavily encourage folks to use when they're going into their housing decision, because it makes that ability. It's about exit options. Yeah. You have 3 fundamental exit options when you go buy your house. One is live in it happily ever after for the rest of your life. Too many people overweight that option and feel like that's the one that's going to be. The second is to keep it as a rental property. Ideally, it's a profitable rental property and not one where you're shelling out money every month, subsidizing the cost of your tenants' housing. And the third is to sell the property for a gain, which I think too many people also just assume the market's going to carry them instead of taking control of that by fixing it up. So how's that for a long-winded answer to your question about what
I thought that was great. And here,
trading?
what I love that you said is again, I love this reframing of thinking about your housing really as this like expense item, right? But we are in this place where like over the last 3 years, real estate's increased 45% in terms of like the average home price. And so people are having a hard time getting into homes. So I'm curious, at BiggerPockets, you said something a second ago. You said, hey, I think that the timeline is extending before the ownership thing makes sense. It used to be 5 to 7 years. Maybe it's a little bit longer. Are there other rules of thumb that you guys apply either to the buying decision or the renting decision? Like in terms of, we talked about down payments a little bit, but down payments, percentage of income that you can spend. What rules of thumb do you give folks, especially when everything is getting more expensive, to make sure they're not getting out ahead of their skis when it comes to their primary residence?
Yeah, so I'll use 3 sets of rules of thumb, right? One is the buy versus rent decision. Do the math and figure out what you have to believe for buying to be better than renting in an equivalent lifestyle component, right? And don't dismiss renting. I have rented for the last 3 years because I did that math for myself, and I own a real estate portfolio, and I'm the CEO of this real estate company, right? Because I did that math, because I didn't want to live in that property necessarily. I wanted to live near a specific park and have a good time there for the next couple of years. And then I just had we just welcomed a new family member. Now it's time to start thinking about a little bit more of a permanent place for me, right? So that's one. The second set of rules is understand your exit options, right? You have three fundamental exit options. You can live in the property, you can rent it out, or you can sell it for a profit. And how do you maximize the odds of having all three of those options for the duration of your time, or as much of that time where you're living in that property as possible? That's freedom. That's flexibility, right? Don't let your house be a trap that keeps you locked in to your current lifestyle for a long period of time. That's not what we want. And then the third, I think is around what are the financial requirements to buy a house and get yourself up ready to buy. So this is getting a little bit more tactical, but I'm actually not a proponent of using a big down payment necessarily. You must have the down payment in cash, whether that's 0% if you're using a VA loan in the military, 5% or 3.5% if you're using a VA or an FHA or conventional loan. You need to have the closing costs. While you can wrap those into the mortgage, I think you can't always do that. And so you need to account for those. And I think that even if you're buying a property in good condition, you need to have $10,000, $15,000 in cash set aside as a buffer for the things that go wrong. There's a direct, I'm being facetious here, relationship between the amount of money that you have set aside for repairs and the amount of repairs you will have. If you don't have any, you will have major expenses. You will call them a disaster. If you do have the money set aside, you're going to call them capital expenditures, and you're not going to have that disaster event. One more thing that's a little bit more qualitative, and this is a pet peeve of mine, is when people buy their first home or their second home, usually the first home, they do so kind of with this mentality. My lease ends in June, therefore I need to buy a property by the end of May, right? So that I have that timeline. Okay. You've just said, okay, the biggest financial decision of my life, which is $400,000, $500,000 on average that I'm going to make, I'm going to rush my timeline and create an artificial deadline in order to buy this $400,000, $500,000 asset. That makes no sense to me. Call your landlord and say, I'm going to go month to month. Pay the extra $200 a month or whatever it is, an increase in price, and get the timeline on your time, right? And here's one, and I'm going to keep going since you got me started here.
This is great. No, keep going.
Okay. But what you do is you don't look at the properties that are for sale on the market right now, because the properties that are currently listed are the ones that have been sitting for a long time disproportionately, right? There's something wrong with them or they're overpriced. What you do is you ground your search in what has sold actually in your market in the last 90 days, right? That's what the price of the property is, right? Or that you're trying to buy. And you keep whittling down your criteria until you have like 5 to 10 that have sold in the last 90 to 180 days. And let's say you get to 5 in the last 190 days. That's one every 18 days or once every 2.5 weeks. So now I've got my month to month rent. I've got myself prepared and I'm going fishing. And when that property hits the market, I can react instantaneously, make an offer and be good to go. That's how you get a good deal or at least a better deal in real estate. But if you go in with I'm going to buy a property before my lease expires, one's going to pop on the market magically. You're going to think your real estate agent's a hero, and you're going to close on it right away. And that your real estate agent's going to big fat commission check, and you're not going to have done this intentionally on your own timeline.
I love that what you did is you put the power back in the buyer's court, right? I'm gonna paraphrase what I just heard you say. Really, when it comes time to buy, you got to do the math, number one, on the rent versus buy decision. You have to understand your exit options. You kind of laid out those three. You have to understand the financial requirements. And then when it does come time to buy, there are things that you can do to put yourself in a position of power to make, which you said is the biggest financial decision on your terms, not on someone else's terms. Do you feel like the reason why we've seen real estate issues in the past, I'm thinking like namely 2007, 2008, 2009, Great Recession, real estate, was because people weren't doing that? They kind of lost sight of being in control when it comes to making those kind of real estate decisions?
I think that's why a lot of people are locked into their housing right now. I think 2007, 2008 was more of like real estate's always going to go up, right? So I run this real estate website, but I have, I think, a healthy fear of the real estate market that I think, too many investors lack or don't have, right? This is not a market that goes up all of the time. This is not a market that is always a great investment. This is a place where you can lose your shirt. And, it's while it's painful for real estate investors, it's particularly painful if your house is your only meaningful investment or the majority of your portfolio, right? The majority of your asset base. So I think that there wasn't a healthy fear of this market in 2008, and I wonder if there wasn't a healthy fear in 2021 and early 2022.
Scott, I want to give you a compliment. You did something with that answer previously that I think a lot of people, real estate is a huge decision. It's something to be respected, not to just take lightly. Most people handle their real estate transactions on their house kind of like you go and retail shop at a big box. And the fact that they will just go see what's on the shelf and they just kind of, what's there. They look for the one that best fits the moment, the window, the 2 weeks that they're looking, and then they just settle and they go with it because, like you said, they make the real estate agent the hero, the hero of the whole story. You completely went. We talk all the time on our show about how much power there is in creating a plan, and a little bit of preparation can have a tremendous exponential benefit. I have never heard anybody lay out the fact that you're actually going to go do all your research. It's no different than like I talk about when we buy cars. Go figure out what everybody else is buying cars on so you're an educated consumer, and then you sit there and lie in wait with your plan for the inventory to start hitting and which ones actually fall into your criteria, and you can not get the ones that just are unpopular or rejected, and now you're just shopping off the shelf. You're actually not custom, but you're at least getting the first bite or the first, feeding of what's available in the marketplace. That's an active role that you don't hear a lot of people talk about with such a huge purchase.
I'm curious.
Well, yeah, awesome. Thank you.
I'm so curious. So you've laid out perfectly this idea around like the primary residence, but a lot of folks and a lot of our audience specifically is really interested in real estate as an investment asset class. So not primary residence, and maybe not even one of those 3 exit strategies that you mentioned where like I'm either house hacking or maybe I move into another house and I keep my old one. But they are specifically and actively thinking, do I need to start investing in real estate, whether that be residential or commercial or something like that? With all the stuff that's gone on in real estate, is it still an attractive investment opportunity for investors who have capital they're looking to deploy, or is now not the time to buy, not the time to be looking at real estate?
Great. So you're going to ask the fox to count the chickens in your coop.
Well, that's what I'm waiting. This is where I am I'm pulling up my financial order of operations. I'm waiting and lying in wait, but go ahead.
Yeah, no. I think, look, who is real estate for, right? Real estate, look, of course, I think real estate is a good asset class. It is not for everyone, not the way that I do it or many of the folks on BiggerPockets do it. And we'll start with the broad and then we'll get into the specific, right? What asset class is good right now in 2023? Are stocks going to go up? Is real estate going to go up? Are bond yields, is bond equity going to increase? Is it good to hold cash? Is it good, crypto? Where do you go?
A lot of unknowns.
Right?
So,
a lot of uncertainty, for sure.
These are the choices that most Americans have, right? So within that, you have to think, what's the best asset class? Or I like to flip the question on its head. What's the least bad asset class, right? So here's my argument for why real estate is the least bad, for some folks, the least bad asset class for as at least a part of the portfolio. And I'll also keep qualifying this by saying, if you want to get into real estate investing and you want to buy a duplex, right, or a single family rental property, there's a requirement that's not financial, it's educational, right? This is that on average, our members spend 250 to 500 hours investing in self-education between listening to podcasts like this, reading books, being a part of forums, those types of things, because everyone knows that you can lose your shirt in this business. There's a million problems that have nothing to do with the market, just with the tenants or the foundation, or you did the math wrong and you forgot that there's not just your rent minus your mortgage payment. It's the vacancy rate. It's the CapEx expense. It's the maintenance. It's the utilities. It's the property management fee that you would pay. Either you should pay it to yourself and factor it in or hire it out. And so all of those things matter. And what we found is that people who earn a very low income, less than a median American household income, you don't really have the means to get to the starting line in most markets around the country to invest in real estate. But people who earn a very high income, while they can be interested in real estate, are not willing to invest 250 hours of their very expensive time into the self-education process. So our kind of sweet spot is this $50,000 to $200,000 per year income earner who's still got a DIY mentality and intends to invest in real estate for at least a decade to get a return on that investment of self-education and time. Now, the next piece is how much time do I want to put into the property once I've bought it, right? And we found that folks that are lower income, not lower income, but in the $50,000 to $100,000 range, tend to DIY more of their property stuff and self-manage their properties or do a lot of the maintenance. And folks who get on the upper end of that spectrum, 100 to 200 plus, they're going to tend to hire out all of that stuff and own that. And the good news is that once you've made this investment of time up front, you can reap the rewards for the remaining 30 to 40 years. Okay, so should you get into real estate? It's if you agree with that framework, right? Same with the home buying process. If I'm going to be in real estate for a long time, there's always a good time to get into real estate. Specifically, tactically, what do I think is going to happen in 2023 and what should I do now? I think the prices are going to come down in 2023. I don't know how much, but we're projecting somewhere between a 3 and 8% nationwide decrease in single family housing, with the caveat that that's going to vary by market. Real estate is local. Right now, what you're seeing is, I think there's a tendency towards national prices coming down a few percentage points, but you're seeing some markets down 19, 20%, and you're seeing some markets up 10, 15% year over year. From a pricing standpoint, I think that's going to continue to be a theme throughout this year. That's going to be heavily reliant on where the new construction in particular has been picking up around the country. And then what do I get into today? Well, first of all, creative finance, right? Assuming these mortgages, if you're a house hacker, that's a great way to start, right? I've actually heard flipping is back. Flipping is a bad activity into a declining rate in a declining market because you're not getting that tailwind. But if you can complete the flips very quickly, your strategy simply shifts from buying high and selling much higher to buying low and selling less low. So I've actually heard a couple of people get successful flips. What has died, but will come back within a year or two, is what we call this BRRRR strategy. I'm sorry if I'm getting too acronym heavy here.
No,
but
this
that's
is great.
Buy, rehab, rent, refinance, repeat. So a lot of investors, instead of flipping properties, were buying properties, fixing them up, and then just putting a 30-year loan on them, cashing out their equity, and doing it again. That's how you build a portfolio very quickly. That has died for a lot of investors in the last year, but I suspect that by the end of this year, it will come back because, why not, right? I'm buying with a high interest rate mortgage, and I'm just refinancing at a higher interest rate mortgage. As long as my cash flow and my math works out, I might be fine to do that. So hopefully that's a quick little overview of what I'm seeing in the real estate market and projections there. We'll see how wrong I am next year. And Scott, you can beat me up for the specifics.
You did a
there.
good job of going through the mental preparation, the education, and I love that you self-classified yourself. We just let the fox inside the hen house. I am going to ask the fox to kind of let us know, because I would be remiss if on the Money Guy show we didn't bring it up. Because look, there's a lot of great benefits to real estate. We've talked about those on a lot of shows. Everybody knows we love real estate. We do real estate as well. But are there things that need to be taken care of, not just mental preparation, but financial preparation? What are some of the basics? Like I immediately think of like cash reserves, Roth IRAs. Where does real estate fall when you're lining up your and look, I'm going to go ahead and take out one of your easy pass. House hacking, I think, is essentially you're buying your primary residence, but you're finding somebody to help you pay that mortgage. So take that off the table. But when does somebody who wants to buy their first standalone real estate investment, are there some financial steps that need to happen first so they don't find out that they might have gotten in this a little too soon?
Like, are you asking, can real estate be the first
I guess because look, here's
someone?
my argument, and I'm trying not to hog the show, but I see, because Scott, I can tell we've gotten a hold of a good one here, so I want to make sure that I give him a chance to actually share. But there are so many people out there telling people real estate is all passive, jump into it as fast as you can, and I just want everybody to have the best, most successful experience with real estate, but it does require, just like Scott talked about, mental preparation and education there's also some financial preparation that's required. And I wanted to give Scott a chance to kind of lay out the way they look at BiggerPockets.
Yeah. So I look, what I think is great about BiggerPockets is there's a ton of different voices and a ton of different perspectives, right? BiggerPockets is not my voice. Like I don't have like the opinion. I have one opinion in the crowd. So there will be people who disagree with this. I am a very strong believer personally that real estate investing comes after a very strong personal financial foundation. What does that look like? To me, I'm pretty strict and aggressive. It looks like several $1,000s at least in spread between the amount of income that you make and the amount you spend after tax hitting your bank account, right? You actually have cash to fund major repairs or float the mortgage if you don't have a tenant for a few months, for example. I think that's critically important. Again, people will disagree with me. I think that having the cash to put down on a down payment is critically important. A big pet peeve of mine is when people take out a HELOC on their primary to buy a rental property. You take out a HELOC you take out a HELOC. Not only are you getting the mortgage payment, you're probably getting a few $100 in cash flow, but you got to pay the HELOC back. HELOC is short-term debt. Even if you're being generous and say you're going to pay it back over 5 years, a $60,000 HELOC is $1,000 a month before I get to the interest. So this property is going to suck cash out of your life for the next 5 years, and maybe you'll come out smiling on the other side. But I want each investment personally to bring cash flow into my life gradually and consistently with a snowball building up, not a snowball piling up against me until I get to this other side. That may never come for a lot of investors. So that's one thing. So build up the cash and the cash flow. I think it can be as simple as that conceptually. We can get into more details around what is the cash. It's the down payment. It's the reserves you're going to have following the purchase of the property. It's the closing costs and the expected repairs. That's how much cash you should have when going into a real estate purchase. How do you do that? Save your pennies, right? Most of the time, this is a grind for several years that people undertake, right? That I'm seeing from a consistent perspective to get that first property. It gets faster as you buy 1, 2, 3, 4. And I've seen a lot of overnight successes doing it this the responsible way in 7 to 10 years. That's a joke. For the amount of time it takes to really build wealth. Real estate's a great vehicle to build several thousand or maybe a couple $100,000 to a couple $1 million net worth with several thousand to maybe several tens of thousands of dollars in passive cash flow. But it's a 7 to 10 year journey, faster than stock investing on average if you're doing it right and using leverage, with more risk and a lot more time commitment, but a very viable approach for some. Is that answering your question?
It does, but I want to kind of, because it just hit me, and this is something, because coming from a public accounting background where I did tax prep, and I did tax prep for people who had a lot of rental property, and I think about the Great Recession. You'll know who I'm talking about. I want to know, Scott, do you like, because I think a brand new real estate investor will be drawn to the low purchase price but high transient population. These is you can go buy a house really cheap, get into an area, but you're not going to collect a ton of rent because the clientele is it's not a high income area. Do you buy those to build out the fundamental rental real estate, or do you build your assets up and try to buy more into an area that the purchase price is going to be higher, but your tenant is going to be much more stable and probably give you what? I just want to get your take, because I've dealt with both, and I'd love to know what your thought towards rental investing is on what people should target.
I think I'd go back to the framework I used earlier around, hey, lower income folks in the $50,000 to $100,000 range are typically want to DIY their properties a lot more than the folks that are in the higher income range. So I think it's a question of the time value of your money, right? Someone who's just getting started out making $75,000 a year is not going to have the option to buy a lot of rental property in the $500,000 plus range. That's going to attract your A tier tenants, right? But they will be able to buy property in the more affordable range, right? That's not going to appreciate on average the same way. It's going to require a lot more active management. There's going to be more difficulties perhaps in managing it that you're going to have to get through, but there's also the higher potential cash flow and returns. So I think it's a matter of practicality. That's where you're going to get started if you're an investor that's earning less than 6 figures in household income and want to get started in this business. And that's a great approach. You do it there. Personally, I'm with you though. Over a long period of time, I'd rather transition out of those types of assets and into a portfolio of the A-class property with really, really good tenants, it'll have less of a cash-on-cash return, but it will be a much better experience, and it may have a similar overall return over a long period of time because of the appreciation and rent growth in those properties.
And how about out-of-town rentals? Because I have a friend who's in real estate, and because our area where we currently live is it had tremendous appreciation. So he was starting to look in other states because the purchase price was so much lower. My spidey senses gave me some pause, but I'd love to hear your take. Do you buy a rental property in an area that's not in your geographic zone?
I think you bias heavily towards buying in your geographic zone. And in some cases, it's just totally impractical, right? And so, but if you're going to buy out of state, then you're going to have to really trust the team that you build there, your agent, your property manager, your contractor, those types of folks. So if you are going to do that, I think it's really good to actually get to know the area, fly there, go look at the property, and commit to it. One of the traps I see with a lot of investors is like, let's say you get a $200,000 a year software engineer out of San Francisco, and they want to go buy in Memphis, Tennessee. So they buy a $50,000 single family home, right? They've got all these problems to deal with. I haven't done all that research, but also even if it goes well, you've got now a property that's going to put $250 a month in your pocket, and you earn $200,000.
Not
right?
moving the needle.
It's just totally insignificant relative to your position, and it's going to occupy too much of the pie chart of your time, even if you try to automate all that stuff. So if you're going to do that, you should go big, right? I mean, intend to go big over 5 to 10 years. Right? I'm not saying take a lot of risk. I'm saying your intention should be, how do I get this thing to actually be 10 to 20% of my annual income in a reasonable period of time? Otherwise, it's not worth doing from a holistic financial perspective.
I'm curious from an investing standpoint. You talk about there's so many people that are locked in. We came through this time where we had these low interest mortgage. So there's not a lot of people leaving and moving, and even the opportunities available for how real estate investors can invest has changed. I'm so curious because I feel like I've had a lot of people over the last 2 or 3 years that have said, "Hey, I want to get into real estate investing. I want to go buy my first single family. I want to go buy my first property," but it feels like the deck is stacked against me because prices keep increasing because it seems like there's a lot of institutional buyers in the market. There's a lot of folks that have been buying tons of what would have been attractive properties to me. And it's interesting, you said that your prediction, or you're kind of like, looking at the crystal ball, you think that 3 to 8% nationwide decline in home values over the next year could potentially manifest. Does the amount of other parties involved, whether it be institutional money or these big institutions that are buying these, does that play into the equation in terms of when someone thinks there might be an opportunity to enter into this side of the equation?
Yeah, so institutional investors, I get asked about this all the time, and it makes headlines when an institution owns a couple 100,000 homes. But if we look at just the rental market, right? So there's 125 million units of housing stock. Now I'm really nerding out. 18 million of them, 28 are 1 to 4 unit properties, 18 million are single family rental units, right? Institutional investors own less than 3% of single family rental units, not single family housing stock, which is 85 million, single family rental units. So in some markets, like Atlanta, Phoenix, Charlotte, a couple of other markets around the country, they are a much bigger share, 7 to 10%, and high as 15% in select certain, if we want to get narrow down to select areas that they've specifically honed in on. So yes, they can be a factor in some of those areas. Some of the folks listening will say, "Oh, the institutions are buying up all the properties in my area," and they're right. But it's not on a nationwide basis. They're almost a non-factor, right? It's the 97.3, right? So who's buying the rest of those rental properties alone, right? Because investor activity has increased as a percentage of overall housing stock. It's gone from 10% to 18% of purchases in the single family space are investors. It's the retail investor. It's the mom and pop landlord. 90% of single family rentals in this country are owned by people with 10 or fewer units, and 50 to 60% are owned by people with just 1 or 2 units. This is my market. I'm the CEO. I talk about these numbers all day long, so this is why I have them off the top of my head. But that's who's really competing with I think the home buyer in a more meaningful sense than the institution, who's very easy to blame. And these people are like me. I own 5 rental properties with 13 units in them, right? So and I'm buying one or two. The average person is buying one or two over a decade,
Right.
and as part of their portfolio.
So it's not as dire as the headlines make it sound. It's not like you're competing against these trillion-dollar entities. No, it's just other investors out there. So it's not
and they're
going to
get
be.
their clocks cleaned, in my opinion.
They're going to get their. So you think that it's not going to end well for them, which means it could be opportunities for folks like you or folks like us that are thinking about other real estate investment opportunities.
Yeah. And one of the big reasons why institutions are such a relative non-factor, and again, they in some cases, they have been a big percentage of purchases in temporary windows, as a lot of people flooded to kind of follow the success of Invitation Homes, which is a very well-run business that is able to keep vacancy. They do a lot of things right. But the fundamental problem for these guys is they're not locking in 30-year fixed rate Fannie Mae insured mortgages, right? They've locked their debt. They have all these swaps. They're not going to be in trouble next year or the year after, but they're going to have to refinance at a certain point, and these portfolios will not make as much sense on a spreadsheet as they do today. And so I think I'm not convinced personally, I might be the only voice saying this, that institutions are a major part of the future of American single family housing stock.
No, I think because look, I had somebody mention to me, I think people have not taken into account what interest rates have done to a lot of these business models. They are going to blow, like you said, it's not like these institutions use 30-year mortgages. They are sitting on much short-term lending terms. They're going to have to refinance. I worry about, that's the thing that people aren't thinking ahead, is what's a few years down the road. Some of these markets, because you said they're very concentrated in specific areas of the country, there might be more inventory, or at least people who are either impacting the rental market, impacting the selling market. There's could be a lot of stuff because this is untested. We didn't have that type of concentration, and I always think about what's the unintended consequences. So that'll be interesting. I loved hearing your take on that, because I don't think it's dire. Like, I answered a question this morning that everybody follows the news media trend and is scared of it, but I always remind people, remember, the financial media doesn't make more money from your wallet growing or your balance sheet and net worth statement growing. They make money from your eyeballs and your ears on their scared content. So be careful of that. I know we're running out of time, so I wanted to kind of spitfire this a little differently. It's because when I think about real estate investing, there's several tiers. There's residential rental. We've talked about that. I guess you could get into multifamily, but that's another part. We have vacation rentals, because I've fallen into this trap myself before. And then we have, I feel like what a lot of people aspire to, I call get rich activities, is commercial. I'd love, while we have such a captured resource, kind of, Scott, if you could share just kind of indicators or things on each of those markets on when it might be a good time for you to consider it, or even measurable things that you say it's a good deal. Because I know back on residential rental forever you heard just go with the 1% rule, but I'm sure all that stuff has been blown up. Are there metrics? And I know that probably each of them applies to different things. Can you I know I've asked for a lot, but like I said, I know we're closing out, and I wanted to make sure I got some of these things answered from you.
I'm happy to go all day on this. You're talking about asking me about my favorite subjects here. So the framework I'll apply is you want to take a property and put it to its highest and best use as an investor, right? So if you're buying a property that's in a part of town that's going to command a high premium for short-term rentals, you turn it into a short-term rental. If it's next to a hospital, perhaps you turn it into a medium-term rental and have traveling nurses stay in the property, right? A popular niche strategy that's kind of springing up. If it's in another part of town, it's a long-term rental, right? If it's another part of town, you might do rent by the room and rent each room for $800 instead of in a 3 or 5 bedroom house, instead of the whole place for $1,200 or $1,500, right? And get spread there, more tenants. But these are all trade-offs around operational activity and investment. You got to furnish the place in one example versus run it unfurnished and do very little in another example. So that's the framework. Another pet peeve, I've listed a few, is I really don't like it when we go to the second home example, when people are like, oh, I'm going to buy a property in my favorite ski town or by the beach and call that an investment, right? These towns are typically excellent at extracting money from people like you and not the other way around, right? That's not how this works. You're going to find that the management fee is going to be super expensive, right? These places are very seasonal and people don't really take that into account and really overestimate the rents they're going to get in the off season. So if you're going to go into this, go make your money in a place that you know really well, that you've selected for income opportunity, and spend that profit on your vacation in your favorite ski town.
Love it.
Don't buy in your favorite ski town or a beach property. I know that's not very popular among many people who have done that.
It's so true, though. They know how to extract because those management contracts are huge. They're taking all the profit. It's amazing.
Yeah, and these towns regularly change. Also, if you're going to do like a short-term rental, understand that the law can change, right? And the people in that town know way more than you about what the law. Like it might be that the law is changing and only a handful of properties are going to get grandfathered in. I mean, it's just constant. Like politics begin to play a role in your investment of your single property that you're buying in one of those places. Okay, so that's that market. Hopefully, that answers some of those questions. You talked about commercial, so I want to go on another 2 or 3 minute rant about commercial. Can I do that, or we
love it.
Please.
Okay, I think commercial real estate is going to crash in 2023 and 2024. I have posted about this very publicly, and what is going on in commercial real estate is very sensitive to interest rates. Unlike public companies, you're highly levered in commercial real estate. And unlike single family housing, which I said is going to go down, but not crash, this is not long-term fixed rate debt for the most part. It's typically has to come due in 5, 7, or 10 years if you're using a Freddie Mac mortgage, for example, in multifamily. And if you're in office or industrial, you have another issue there. Interest rates are extremely problematic. That mortgage payment that you talked about, going from an average of $1,314 to $2,900 per month, that is amplified dramatically in commercial real estate, where typically the folks that have variable interest rates have to pay for swaps in order to make sure that they're meeting debt service. So if these folks are coming due, they're going to have to bring piles of cash to the table to begin meeting what's called debt service coverage ratios, because the payments have ballooned so much that's actually a higher payment than the cash flow of the property generates. Right? They typically borrow such that they're generating $50,000 on a $41,000 debt service, right, and cash flow, right? Double interest rates. All of a sudden, instead of having $41,000 in debt service, you have $48,000 in debt, or I'm sorry, $58,000 in debt service on the same loan balance, right? So even if you are fixed for 5, 7, or 10 years, your buyer, who you're trying to sell it to, can't buy that property at the same price point unless they bring an incredible amount of cash, and everyone's out of cash right now because they can't refinance their properties or sell them at the previous levels. So this market is at a standstill right now, where there's a huge bid-ask spread and transaction volume has essentially collapsed in this world. And compounding that, in the multifamily space, we have the most new construction units ever coming online for housing stock when you combine multifamily properties and single family properties. Why is that? Because the last few years have been so good for real estate that builders started going to town. And it takes 2 or 3 years to get permitted and for this inventory to come online. You can see exactly, you don't have to guess. This is not like a forecast I'm giving you. It's literally there. Here's all the starts that are in progress, and here's how many are coming online in 2023 and 2024, and it's the most ever. Think that's going to put pressure on rents? I think rents are going down in many markets around the country. By the way, this is going to hit the South and the West hardest because the data is really good. It just breaks it out by region. So I think that's when you have no rent growth, a very good reasonable chance at no rent growth in this country for a year, and you have all of the supply coming online and your interest rate has doubled. You could have made all the best decisions in the world and you're going to be in for some trouble. So I think that by the end of this year and early 2024, you're going to see a lot of really good opportunities in the commercial markets.
Well, I think it's interesting, Scott, because forever on social media, you heard all these people pitching the multifamily. And it was with interest rates being so low, you buy an old apartment complex, you rehab it, you cost segregate it, take all that accelerated depreciation. On paper, they syndicated this or sold it. I mean, a lot of people got in on this stuff, and as long as their terms, like you said, the interest rate on the deal, how long they win is really what's going to kind of be the look-see to tell them if they're going to be okay. But I think a lot of people might get caught. I do want to defend commercial in one way though, because this is one of those get rich activities. Because I pick on small business owners. I always ask them when I'm talking to prospects and others. I'm saying, okay, so you're a dentist, you're an accountant, or you're in real estate. I was like, do you own the building that you have your business in, that you have all your employees? And if they say no, I'm always a little disappointed, because I do think that if you own a company and you're an employer and you have people there, you should aspire to own the building that you're paying rent to, because it serves in multiple ways. First of all, 504 loans at the Small Business Administration, they let you protect against all that being squeezed out on the term, because they can do a 25-year. I think they even go out as 30 years on those 504 loans. The other thing is, when you eventually get bought out, whoever bought your company is probably going to pay you the rent. So that one is because it's just like primary residence. You live in the house, you get a better deal because the banks see you as less risk. Commercial, for a lot of people, if you can quit paying rent to somebody else and start paying yourself, it's a tremendous benefit. And that's what, but I don't think you're wrong on, I think it all goes back. It doesn't matter if it's commercial. It doesn't matter if it's multifamily. It doesn't matter if it's residential rental with all these institutions buying. That interest rate risk, the same thing that's crushing banks right now on the stickiness of relationships, is going to have a direct ripple effect into the mortgage marketplace. It remains to be seen how long those terms, the duration on those loans are. So, but it's fast. This stuff is fascinating. It really is. And I think Scott nerds out just like we do.
I completely agree with everything you said there. And I just want to chime in. House hacking, the tactic I described earlier, I think why would you ever not do that, right? It would have to take a really unusual set of circumstances for that to be way worse than renting or owning your house. And business hacking, which is what I'll call what you just described there, same concept, renting the place or owning the place that you lease from, is probably almost always a great investment. I mean, you can't, it's not always, but why wouldn't you do it? I completely agree with that sentiment, really, in any market condition. Yeah.
God, this has been awesome. If somebody wants to know more about you or about BiggerPockets or about real estate investing, what's something we can point them towards where they can get themselves educated? I think you said it was 250 to 500 hours before you're well equipped to enter into this. Where can they go to begin working on that education component?
Another Fox chicken question. I'm a big fan of BiggerPockets, right? We've got a podcast, we've got YouTube channel, we've got blogs, we've got 30 plus different books on various real estate strategies. So that's a great place to immerse yourself. And many of the folks who come on and appear on those also have good content. So you can find some really good, smart folks, follow their stuff too. And that's, I think, the way down the rabbit hole. And one thing I'll plug here, you mentioned Set for Life, but I also wrote another book called First Time Homebuyer, which goes through what we just talked about at the early part of that, where, hey, here's how to think about your home first from a exit options standpoint, the rent versus buy decision, the tactics to set you up for success. So that might be helpful for some folks as well if they're particularly interested in how to make a good first-time home purchase decision.
Well, Scott, this has been a blast. I loved, you could very easily see that your mind works in a systematic way. And that's truthfully, that's what creates success, is if you can actually know what you want to achieve, but then you actually create a way to have incremental decision-making through a system. Scott gets it. Yep. And that's why this was so fun. I got to be honest, giving feedback, I didn't know how it was going to go, because we real estate investors, a lot of people make their money in real estate. Other people make their money in investing with the index funds and things like that. But I really do think we found the right marriage of where they all can coexist. Everything has a time and a place as you reach your level of success. Guys, thanks so much for tuning in. I would be remiss if I didn't say go check out all of our free resources, moneyguy.com/resources. Also, make sure you let us know, do you like us having guests? If you want more of this type of stuff, tune in, let us know. I'm your host, Brian Preston, Mr. Bo Hansen. Scott, thanks for joining us. Money Guy team, out.